Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. This episode is going to cover the basics of insurance, including car insurance and health insurance. So what is insurance and why do we pay for it?
Well, insurance is basically a mechanism that people use because we all have risks in life. There are a variety of risks, things that could happen that are unforeseen, okay? And some of those risks could very badly damage us financially, right? A car accident that, someone gets killed and there's a lawsuit over it and everything like that. Or your house burns down, or a breadwinner in a family dies, okay? So those are all risks, and what insurance does is it manages these risks for us. It takes them from being catastrophic to something affordable to deal with. So, for example, you're a breadwinner, where if a 40-year-old breadwinner of a family dies, and now we need money to take care of a family until kids are through college, and for a spouse who's now lost the income from the husband or from the wife, whichever. What we do is we turn that multi-million-dollar problem, let's say, into a small premium amount, a small cost to them on a monthly basis. So the risk is transferred to the insurance company, instead of those people taking on that risk.
And you just put money into it.
You put money into it. The money's called the premium.
The premium.
Okay, and that's why. So that's why we pay for the insurance. The premium for the insurance. It's because by paying that, the insurance company takes over a risk that we either can't afford to take or just simply don't want to take.
Okay.
Again, the homeowner's insurance. If the house burns down, if you have a $400,000 house and you don't have $400,000 lying around to replace the house, and the house burns down, you don't have a house. You're just out of luck. But if you have $400,000 of insurance from homeowners insurance, they have taken that risk that the house would burn down. You paid them $1,000 a year, and you've managed that risk by paying a small amount of money to get a large amount of money to fix a catastrophic problem.
So how does an insurance company come up with the amount that we're going to owe them?
Okay. Well, an insurance company has lots of people that have a job that we call actuary. Actuaries are people who have to be terribly familiar with probabilities of certain kinds of events happening. So what's the probability of your house burning down? What's the probability of a 45-year-old female dying from any cause? What's the probability of a hurricane hitting Florida or something like that? Car crash. So they are very, very familiar with these probabilities, and they also know how much money those risks represent to them in the policies that they're creating. So you take the probability that something will happen, and you take the amount of money that you're going to have to pay out if it does happen, and you spread that probability. Say it's going to happen one time in 2,000 families, for the sake of argument, 2,000 policies. So what you charge for that, it's going to be basically a couple of things. Number one, it's got to be enough to make sure that if that happens once in those 2,000 times, that you have enough money to pay the claim, to pay off the people whose policy now needs to be paid off. The second thing is it has to be enough to cover the expenses of the insurance company, or a portion of the expenses of the insurance company. And then finally, it's got to be enough to be profitable, because insurance companies are in business to be profitable, not just to not just to cover the thing. If they're not profitable, they can't grow. They can't move forward and expand their lines of insurance or help other people, et cetera, et cetera. So that's basically how they come up with a price for it. They look at the probability of a loss. They look at what that loss would be. They look at spreading that across how many policyholders, and then their expenses and something for profit.
Okay. And now I've also heard of something called bundling. Does that also affect price?
It does, but that's more for the benefit of the policyholder.
Okay.
So if you, for example, have your homeowner's insurance and your car insurance and your boat insurance or some other kind of insurance,
Got a boat.
well, go get one. If you had all those insurance coverages with one company, they would give you discounts on those because you've got all your
given
business
them
there.
Your business.
Right, correct.
I understand.
That's
okay.
right, yep.
And now, so where does my money go if I don't actually have any incidents that they would need to cover, that insurance would need to cover?
Well, it goes to three places. It goes to cover the incidences that do happen, but aren't you, right? Because these things do happen.
Yeah.
Somebody's going to have a car accident today.
Yeah.
And it may not be us, God willing. It's not us, but somebody's going to have a car accident. So it goes to pay for that. It goes to pay for the expenses of the company. And if they've managed it well, it goes to the profit of the company. So the company uses that money to expand.
So basically you have a bunch of different people paying in monthly, regularly with their premium.
Right. Yep.
Right. So then the money is pooled.
That's
and
correct.
then it goes towards whoever needs it at whatever given moment.
That's correct. I can give you an old example of this real quickly. The first life insurance policy, the story goes that someone walked through a cemetery and calculated at what ages people were dying and figured out, if we wanted to be able to give, say, $500 to a family if somebody died, they figured out what the likelihood was of all those people dying, and if they were going to have to pay out $500, how much they would need all those people to give in. So it might be all of them needed to give in $1, so that there was a $500 pool in the event that one of them died.
Okay.
So that's all it is in concept. It's just in a much bigger, a much more complicated way, but in basic concept, that's all it is.
And so I know there are a ton of types of insurance, but for the sake of a young adult watching this, I'm thinking let's talk about car insurance.
Okay.
What does car insurance typically cover?
Okay. Well, typically, start with the car itself. So if there is an accident, it covers fixing the car, trying to restore it to its pre-accident condition, something along those lines, okay? In some cases, there is so much damage that it doesn't make sense to try to fix the car, and they call that totaled. So if your car is totaled, it means it's so damaged that it's really beyond repair.
Yeah.
And it's nonsensical to try to repair it. So fixing the car damage is the first thing that typically gets covered. The second thing that gets covered is whether or not anybody is injured in the accident. Even other cars, because if you're at fault, most insurance today is what's called no fault, which means they don't actually determine fault, but there are some ways that you can determine fault. For example, if you hit somebody from behind, basically it's your fault. There's not really much, unless the other person backed up into you and you need to have a camera rolling to prove that that's what happened, okay? But if you hit somebody from behind, it's basically your fault. So your car insurance probably is going to also go to pay for the fixing of that other car in such an instance. So then you have the personal injury part of it. So if you are injured or if someone else in the accident is injured, someone in the other car is injured, again, getting back to if there's responsibility, it pays for that. Okay. And the third main thing that it pays for is damage to other property. So you take down a telephone pole in your accident, or you crash into a house, or you crash into a building or the front, a storefront, and take down the window, the glass, and everything. So it covers that, the damage to property as well. Some policies will have some other bells and whistles that would be things like money to rent another car for a period of time while yours is being fixed. Small things like that are ancillary, but the big parts of it are damage to cars, damage to individuals, and then there's another part of it which is just general liability. In other words, if you get sued for what happened,
there's a lawsuit,
then it may cover that as well. Okay.
That's very good to know, very useful information. I know that age tends to be a big factor in determining The price of car insurance?
Yes.
Why would you say that is?
Well, age is a proxy for experience, typically. Okay, so if a person has very limited experience driving a car, they are more likely to have an accident. Those people called actuaries, that's one of the statistics that they look at.
Yeah.
What is the probability of a 20-year-old having an accident versus a 50-year-old who's been driving for 33 years at that point, let's say. So the probability being greater of one event happening than the other, it costs more money to buy that policy because it's more likely to be used. So that's the reason why it costs more money.
Does it also then, as you get older, if you stay on the same policy, does it then go down?
All other things being equal, yes.
Okay.
It should go down.
As long as you haven't had a ton of car crash. Does your car insurance goes up if you have a car crash, right?
Well, it can.
If it's your
It can.
fault.
Some companies won't do it with your first accident, but they might after that.
Because the risk
It also
goes up.
depends on blame. Again,
Yeah.
if you get hit from behind,
Then it's
you're
not
probably
your
not
fault.
going to have as much of an issue.
Okay. Let's switch over to health insurance, which is also very important. What do you think is most pertinent to know in terms of differentiating policies?
Okay, so number one, what the coverages are in general for things like doctors and specialists, going into a hospital, emergency room coverage, if you need pharmaceuticals or drugs, wellness visits, some of these kinds of things. Okay, so what do they cover of those items?
Be different for
And what
each
will they not cover of
policy.
those items? These differentiate policies a lot. Now there also are some structural things that differentiate. Things like if you have a doctor and you want to go to a specialist, do you need the permission of your doctor to go to the specialist? Do you need the permission of the insurance company to go to the specialist? Or are you able to choose to go to a specialist or go to a different doctor or do a test or something like that without permission and still have it be covered? Okay, so that permissioning aspect is a really big differentiator, and that's where you get into things like a whole bunch of acronyms, HMOs, PPO, like just all these different types of things. That's what a lot of that gets down to. The final differentiators have to do with copays and deductibles and family deductibles, meaning what percentage of something do you pay or what dollar amount of something do you pay?
Is that the copay?
A copay would be a dollar amount that you
Okay.
pay, say, when you go to a doctor.
Okay.
You have a $30 copay for the doctor. All you pay is $30 and the insurance company pays the balance.
And does that normally differ depending on what doctor you go to?
Yes, your general practitioner is usually cheaper than going to a specialist of some kind. Yep. So so that's your copay. You also can have a deductible. You might pay the first $1,000 of all expenses, other than say the doctor visit, but hospital or not pharmaceuticals generally, but hospital or tests, for example. You might pay the first $1,000 before the insurance company starts to pay anything. So knowing what your deductible is very, very important to being aware of what's going to happen if you need the insurance.
Are there any factors that will affect how high your deductible is or how low it is, like how much you'll have to pay before insurance
Yeah,
get
it's the
involved?
other way around actually. How much you have to pay is affected by how high you set these deductibles and everything else. So to the degree that you take risk on yourself, you take a higher deductible, for example, or higher copays, higher family limits and things like that, you will pay less money because the insurance company in your premium because the insurance company is less likely to pay something.
Okay.
Or they think they're going to pay less at the end of the day for that policy.
Okay.
So
kind of evens out depending on where you're putting your money.
Well, it also assumes you're paying the premium. You know, if you're an employee and somebody else is paying the premium, their interest is in having higher deductibles and, you know, more risk on the back of the employee for costs rather than the other way around. And so the employees aren't crazy about that. But on the other hand, medical insurance is very expensive. It just continues to be very expensive and to grow at rates much faster than other expenses for most companies. So as a result of that, these are the kinds of things that employers look at in order to reduce their costs with it.
Wow, that's a lot I didn't know. I feel really educated. And that's actually just the first installment of insurance. So make sure to watch the next couple videos because we're going to clear up even more. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website and make sure to click on to the next.